In this podcast, we will talk about Fed's minutes. David, what are Fed's minutes and why is it important? The stock market had a big rally after Fed's minutes were released.
Investors should pay close attention to Fed's minutes, as it shows the Fed's views on inflation, economy, as well as interest rate. The potential change of Fed's tone matters most to investors.
Investors are all watching whether the Fed continues to be hawkish or becomes slightly dovish. If Fed minutes show some sign that Fed will slow down interest rate increase, investors will start increasing their exposure to the stock.
Let us see what are the key points from Fed's minutes. Number 1. Federal Reserve officials expect to switch to smaller interest rate increases. Number 2. Some officials expressed concern over the impact rate increases could have on financial stability and the economy. Number 3. Though hinting that less severe moves were ahead, they will still see few signs of inflation abating.
I think the Fed did a good job to manage the interest rate. Some argue that the Fed increases interest rates too fast, however. I think the Fed needs to slow down and give some time to watch if inflation comes down or if the economy still holds up well after aggressive interest rate hikes.
Markets had been looking for clues about not only what the next rate hike might look like, but also for how far policymakers think they'll have to go to next year to make satisfactory progress against inflation.
That is right. I think the Fed needs to slow down the pace as the impacts on the economy and financial systems needs to be watched closely. David, have you ever considered continued rapid policy tightening would raise risks of financial instability?
Yes, in fact, there's far from a consensus view as various policymakers saw rates peaking at a higher level than previously expected. So far, some disagreement as to how far these rates should go.
I think the main concern now for the majority of investors is that the economy will go into a recession next year. It seems inevitable that with inflation and interest rate hikes, economic activities will slow down. According to Bloomberg, Federal Reserve staff economists state the chances of a U.S. recession in the next year edges near 50%. Some macro analysts expect a 100% chance for the U.S. economy to enter a recession in 2023.
Of course, this is all due to the slower consumer spending, global economic risks, and interest rate hikes. Policymakers continue to stress on their strong commitment in bringing down inflation, although support for a higher rate peak may have been less than universal. Edric, Fed officials have recently been discussing the turmoil inside of the UK government bond market and claimed that the US Treasuries remained orderly.
Yes, I believe a few participants even suggested the Fed should be prepared to address any US market functioning issues in ways that would not affect the stance of monetary policy, especially during episodes of monetary policy tightening. I think market focuses will sooner or later to switch to fundamental issues that we will all face, which is recession.
I think we should host another podcast talking about recession and what you should know and how to prepare yourself for economic recession.
I agree. Please follow up for the next podcast. Thanks for watching Edric and David Fireside Chat.